record productivity, oil prices continue their rise. With tensions still pretty high in the Middle East, the fundamental picture, according to our next guests, are looking a little iffy, but we'll get into that. What are the expectations from here for oil? And how might Canada's TMX pipeline, for instance, which is set to begin commercial operation just around the corner on May the 1st, change the energy landscape? Joining me now for a global tour of energy markets, including a discussion on some of the tailwinds and headwinds facing energy companies today, are Fidelity Equity Research Analysts, Hwang and Lulu. I'm glad to have both of you here today. Welcome.
Thanks for having us.
Delighted to have this conversation with you, and we'll extend it to everyone who's joining here today. Send questions in for Jin and Lulu over the next half an hour or so, and we'll dig into them. I'll ask you to introduce yourself a little bit. You cover different aspects of this large, global, fascinating part of the economy. What do you cover, Lulu?
My name is Lulu. So I cover midstream names like pipelines, and I also cover oil field services, including like drillers, pumpers, and chemicals, and air compression units, those type of things. Yeah, abroad.
Things that we put in to make things more liquid to go through pipelines, all that kind of stuff.
Yeah, and how to like drilling the wells, those type of things.
Making it all happen. And your focus is on upstream. Tell us more.
Sure. Yeah, I'm relatively new to Fidelity, spending time in upstream and integrated, so effectively the front lines of the sector, if you will.
Front lines of the sector. You're relatively new, and actually, I won't embarrass you here, but you've come to look at oil investing maybe through a different lens, literally, because it looked like a whole lot of distressed stuff for a little while there.
Yeah.
What do you see now?
Yeah, it's I guess to help answer that, I provided a bit of context on my background here. So prior to joining Fidelity, I spent most of my career as a generalist across firms in Toronto, New York, Los Angeles, and my core focus has always been on finding high quality compounder type businesses. So I naturally kind of had an aversion towards commodity businesses, particularly those within energy. It's a more speculative space is kind of the historical narrative. I frankly did bring some of that bias to Fidelity when I joined, but as I started unpacking the sector for the first time, I've been frankly amazed at how much the sector's changed in the last couple of years. If you would just go look back at the history of oil, it was drill, drill, drill. That was the motto. If you weren't growing, then you weren't really worth much to the market. And if you think about the incentives that creates, bloated cost structures, mismanaged assets, really levered balance sheets in a way that fed to that speculative narrative on the space. COVID changed all that. COVID really changed the narrative there. Sentiment really bottomed out at the trough, once oil prices got negative, capital sort of dried up in the sector in a pretty aggressive way. And all these producers all of a sudden had to start reinventing the wheel a little bit and start thinking a little differently. So how did they do that? Clean up the balance sheets a little bit, work through a little, more operational efficiencies. And more importantly, instead of taking every dollar, plowing it back into the ground to grow, you're starting to return that money to shareholders for the first time. So
and they were really forced to. I mean, that was
exactly.
it was like an absolute do or die situation. Lulu, take us through a little bit of what you're seeing through some of those companies. Sometimes they call it the picks and shovels that deal with this same actually new fundamental story potentially. What's happening in oil services?
Yeah, in the services also a very interesting story because as the producers, the E&Ps are become more disciplined, we see there's like a less volatility in the activities level. So that means could translate into like better valuation, higher multiple down the road. And also over the past few years, similar to like E&Ps, there's a lot of consolidation within the space. Yeah, for like certain subset categories, like a top player control like 40 to 75% of market share. So that means they have a better pricing power. They can like have a better earnings over the cycles. Means like higher lows, higher highs, and then also like across the past few years, we see those people have like better balance sheet. What that means, like even the commodity price like decline, they can survive the worst case scenario. And on top of that, if the commodity price stay like very healthy, they have a much better like a flexibility to do M&As, buybacks, and then the management team actually is pretty like right now like really focused on capital discipline, initiate the dividends, doing more buybacks. This is all very supportive to the sector.
I mean, this is massive because it changes from being stuck to the oil price. Even Canada being stuck to the oil price. So, the way that Canada is seen through a prism of it's an oil producer. Therefore, the economy is doing well or not based on the oil price. These companies are busting through that narrative, aren't they?
Absolutely. Yeah, it's interesting. And on the Canada piece, it's a different environment than it has been historically. Frankly, Canada was probably the most hated energy sector for a very long time and probably for good reason. We're blessed with an abundance of resource and probably some of the best engineering talent in the world. The challenge is just, we just have not been able to get our barrels to the demand markets where they're needed. Like you said, TMX coming online May 1st, that changes the narrative. We create excess pipeline capacity for the first time effectively in a decade, and that will let producers grow and also let them realize, fair value for the barrels that they're sending out to the US internationally.
As you say, growing what we can export. Tell us about the pipeline story itself and a little bit about, there are different ways that pipelines are being owned, how shareholders are arranged. Just give us a bit of an outline, TMX being sort of the centerpiece, but the pipeline story generally.
Yeah, so TMS is a private company and then it's kind of owned by the government, but that's really kind of as Jim mentioned, it's really kind of initiate more kind of growth opportunity down road. And then on top of that, even for like certain names, they own like mainline or like they still can grow like the bottleneck opportunities. And on top of that, there's a LNG Canada that probably gonna come in like in later half of this year and early next year. That could unlock some opportunities to like in a money basis as well. So there's a lot of like growing opportunity for the pipeline company to capture that growth.
It's fascinating. And you mentioned, Jin, that maybe the Canadian oil sector was the most loved globally. Let's go globally now and take a look at how Canada looks in that global story. Give us the broad strokes of, OPEC is different than what it used to be. It has different goals. It has a lot of the same members, but some of them have different reasons why they're jockeying in either direction. Tell us about OPEC a little bit, and then we'll
absolutely. It's interesting because the big fear with respect to OPEC is there's a lot of spare capacity sitting on the sidelines today, and people are making different bets on that. If you think about the bet that was made historically, it was always that, look, Saudi needs at least $80 Brent roughly to kind of keep the balance, to keep the budgets balanced. And that was just a bet on their willingness to keep that floor. That has historically been kind of a bad bet. We've seen it happen many times in the last couple of years. Today's bet's a little different. We're actually well above that price today. And so it's more a bet of the more marginal OPEC producers having the restraint to not go to the next OPEC meeting and say, look, we're well above the break-even price today. Why not start growing into this? And that's a fundamentally and much easier bet, frankly, to make than the one we've historically seen.
Who are the marginal players? Who are you talking about?
Kind of look at the Nigerias of the world and kind of all those, the more peripheral nations that, Saudi can stay restrained for as long as they need to. But once you start showing a higher price well above what they've historically kind of quoted, you start to get a little impatient, right?
Right. It's really interesting, the whole spare capacity. How does the spare capacity discussion affect the oil? They're the ones that are actually putting into bear getting more out or less. There's a lot of sort of the mechanics of making that spare capacity either turn it on or turn it off. How does that fit with the companies that you watch?
Yeah, for the company I watch, it's kind of interesting for my midstream and oil field services names, given that the E&Ps is more disciplined, they're not that sensitive to kind of oil price anymore. Like in the past, like because E&Ps, they will spend a lot of money whenever they have a good cash flow, they will like drill. So spend a lot of capital on that. So it's very sensitive to commodity price. But nowadays, it's no longer that sensitive. So we can see like more stable cash flow is more ratable business. In the oil field services names, even like for midstream, it's amazing, like because they have like most of them are kind of contracted, so their business is very stable and more kind of sensitive to the interest rate. And on the spare capacity, maybe just to address that, I think given that the entire kind of macro supply demand landscape, I think the OPEC they're very intelligent and smart. They kind of know like when to kind of put the trigger on different things to balance the market. So generally speaking, I think the spare capacity could be an overhang, but maybe it's not as big as people think in the last cycles. Yeah.
Okay, it's really interesting to hear that. Let's go to interest rates now. Let's talk about that. We all know the story. We've been watching it ad nauseum for sure. It's surprising that we have such high interest rates and we see oil prices going higher. They together can cause problems. Again, tell us a little bit about how that goes to the fundamentals, if it does at all.
Yeah, it's interesting. If you think about where we started the year, I think oil prices were a little more fundamentally driven. A lot of people had the range-bound view of the commodity. And then in the last couple of months, we've kind of seen the uptick over time, mostly as a function of a bit of the risk premium aspect, i.e. the more speculative piece of the commodity starting to factor in for the first time. And then equally a bit more of the reflation trade. You're seeing a little more inflationary headwinds coming back into the market for the first time. So look, as you think about the more speculative pieces, no one really has a good answer at the end of the day. But what I do know is kind of twofold. One is we're sitting well above the marginal cost of production on the commodity today. And that naturally leads to some sort of corrective response over time, whether it's today or kind of years in the future, it does come. And then secondarily, the OPEC spare capacity piece that I kind of referred to. But as you think about the direction at this point, look, can oil prices continue at this level for a while? 100%. But
You didn't say $100, did you?
100%. And then as you think about the two kind of specters of sitting above the cost of production and the OPEC, you have to approach the sector prudently, but thankfully there's enough quality businesses out there that work at kind of more economic reasonable prices.
I want to go into the consolidation story for both of you in a second.
Yep.
Let's come back to interest rates for a second, though. The sensitivity to interest rates, we don't seem to know if they're coming down. Again, how does this affect your industry?
Yeah, so we don't really need to bet on that, whether interest rate coming down, but directionally will travel probably, given that we're already at a peak rate, so probably direction travel will kind of gradually grinding down. And then for my names, it's most like yield sensitive names are in the midstream because they have relatively higher leverage, it's more sensitive to interest rate. So I think that could be the potential tailwind for some of the midstream on top of the volume growth and then pricing growth.
It was an amazing time in the middle of the very early stages of the pandemic where we saw the oil ETF, the global, go to zero. I think everyone was like, I don't care what's on my calendar, I'm just going to watch this happen. That led to a really interesting time, obviously, and you know, some travel back upwards because where else could it go ultimately? But we did see a period of consolidation through for all kinds of reasons. That was certainly one of the glaring, interesting pieces of it. Tell us about the consolidation in this country. For the companies that you watch, there are less players today.
Mm-hmm. Yeah, certainly. It's been a big theme in the US in particular, mostly because the shale resource is one that's very, very economic, but it's hard to, particularly in the US, continue to build tier one inventory today. Again, because you're not allowed to go explore with each incremental free cash flow dollar, you actually have to start putting it back into the business. Exploration has kind of suffered as a result. So M&A has mostly been in the interest of rebuilding that tier one inventory. As you think about Canada, again, we're blessed with an abundance of really, really economic resource. A lot of the companies you see, whether it's in the oil sands or kind of in BC, decades of inventory is not our problem. So it's not as much of a story here just yet.
Right. Okay. And consolidation, again, it's been happening everywhere. The big have gotten bigger. What's been an interesting sort of piece of that to you? Is this greater efficiencies or what would you point to?
Yeah, I think there's a couple factors impacting that. Like consolidation first within the sector, like oil field services sector, it makes the top layer even stronger. So that's definitely they're benefiting from gaining share and then have a more pricing power translated into better earnings. And then on top of that, like E&P's consolidation also benefiting them because if you see the top players in the oil field services name after the M&A, they are become more exposed to high quality companies. So they are they're more defensive in terms of like a downturn or more volatility. So that's another factor benefiting them. And then on top of that, as kind of Jean mentioned, there's maybe the reservoir getting a little bit worse, but then certain names in oil field services name, they can benefiting from that because probably more service intensity will be used, like more product could be used. So this is really come down to stock picking. That's what kind of Fidelity is good at. We try to pick the winners and losers within the sector.
How does technology come in for both of what you're covering to aid in illustrating who's a winner and a loser? I mean, we AI, I'll say it, okay? So it's AI. Is there any impact in technological advances right now in terms of figuring out who the winners and losers are, or are we just not there yet?
Yeah, I think
for both of you.
Yeah, I think the impact is mostly seen on the productivity side of things. We can have a separate AI discussion, but you're seeing, again, as a function of the more restraint on these businesses, you're starting to see them doing a lot more with less. And so you're seeing maybe they can do things with 2 rigs as opposed to 3 at any given time. That's where the technology element comes from. And you're going to see that continue because, again, I don't think shareholders are willing to give them back the keys just yet to grow. So in the absence of that, you just have to find ways to continue to grind out incremental improvement. And that's where the technology piece comes in.
It's fascinating, that shareholder push.
I
mean, what's the next leg of that? Or are they just holding?
Yeah, no, we're still in kind of the early stages of it. What's happened in the last couple of years is the balance sheets have been cleaned up. So now it's about, okay, now that I do have free cash flow available to me, what do I start doing with that? But again, from my generalist perspective and in kind of my history, my bias against the space, this is really exciting time to own these businesses because they're starting to feel and sort of look like real businesses for the first time, as opposed to the more speculative kind of securities that they were viewed as in the past.
Yeah. Did you want to add to that?
Yeah, so maybe on the technology front, especially for the oil field services names, some are use a lot of like improving or innovating in terms of the technology to see how to best find the best reservoir in the oil fields field.
Exactly.
Yeah, and
For
also
the exploration.
yeah, for the exploration, and also like in terms of drilling as well, where they can avoid some like bumps and holes in the wells. This is all kind of improving efficiency both for E&Ps, but they can also charge for incrementally higher price. So that's also translating into better earnings.
It is. Okay. So is it coming? It's coming into the valuation story. It's coming into the earnings story.
Coming to the earnings story.
The earnings story.
Yeah.
Have those benefits been priced in, would you say?
Yeah, I would say
There's
like
more to go,
there's definitely more to go, and the some is priced in the sense of we already see like kind of the people might be expecting like an earning decline if the rig count we have seen like US rig count has been declining, but the earnings hasn't been declining. That's dramatically compared to the last cycle. So this is part people start to realize, but then also like if you look at their kind of sort of valuation metrics, like some of the names still trading at like 12 valuation,
Right.
even the stock ran up like 30-40% year to date.
So you've got room for the price following earnings.
Yeah,
Yeah,
definitely.
that story is in there. Really interesting. Okay, lots of questions coming in. Let's hit a couple of these along the way. I'll ask both of you. This is again, it's a very interesting macro question. So can you help us understand the divergence between gas and oil prices? I mean, there's spare capacity in both cases.
Yep.
What's the deal?
Yeah, gas is an entirely different beast here. The key theme there is that we've been overproducing within both the US and Canada for quite some time now, and you're seeing that in storage figures. If you look at Canada, storage is close to 70-80% above seasonal averages at this point. The story and the hope there is that once all the LNG capacity comes online, both in Western Canada and the US Gulf Coast, that starts to soak up a lot of the excess production in a way where, okay, maybe we do end up in a squeeze situation in 2025, where you can play a bit more of a reversion back to kind of normal economic levels and then something above that. So
Is it too early?
it's too early to call at this point, I would say, and I've used this word a lot across the office, but it's path dependent. It sort of depends where rigs kind of in the marginal plays within North America end up kind of by the end of this year. But it's something we're watching closely, but it's certainly one that's continuing to evolve day by day.
What would you add to sort of the oil and the gas prices that we're watching? Anything to add? Maybe that's it.
Not so much on the prices, but it's kind of a different player has a different exposure, different mix to crude and oil and crude and gas. So this is where we can kind of stock pick like between like midstream names and like oil field services names. Yeah.
Okay, a couple other questions here. Thoughts on IOL producing autogas here at home? Do you know what that means? No, we're going to skip that one. Okay. Do you think that Ukraine's targeting of distribution facilities in Russia, okay, so we go political here, is expected to have a significant impact on price supply? I mean, you can sort of blow that out to sort of the geopolitical and how you plan for that one way or the other. But yeah, I mean, what do you say to that? I mean, it's not a nothing, that's for sure.
It's not a nothing for sure, but what you've normally seen from a lot of these refineries, particularly on the Russian side, is that they rebuild fairly quickly. There is some supply kind of parts availability challenges there, but the expectations in the coming months that kind of gets rebuilt. The main impact where you'd see that is in the refining market. We've been structurally undersupplied in refining for a long time, mostly because production during the pandemic kind of slowed down. So you saw diesel inventories, which is kind of a big driver within refining margins, start to blow out for a while. You start to see kind of things get a little bit tight for a while. So we've improved significantly since those depths. It's just a matter of, how long are these refineries going to be offline for and kind of what inventories look like exactly. But the expectation is over time, look, all the refineries are now kind of humming at this point. So we should be able to rebuild inventories fairly quickly.
Okay. How does that trickle down to obviously what you're doing? I mean, that's the refinery is a big piece of it all.
Yeah, the refinery, we have some exposure. Most of the refinery in Canada are kind of within the integrated, like certain names in my coverage kind of also have like a refinery, but mainly on kind of smaller pieces. But then we have seen like a pretty constructive, like a crack over the past few years. And then this is down to the time, like, would that normalize going forward, given that Jim mentioned that maybe capacity will come online? So how we can pick maybe the refining market that's more defensive, that's more protective from that, is like certain regions in Canada is like more isolated from the rest of the world. They can benefit from more isolated market.
That's so interesting. Say more about that.
Yeah, so so there's certain kind of, for example, like maybe like West Coast area in Canada, there's very few refinery in that region, so they are more isolated from that. So all the kind of products inputs have to be imported from other regions.
So the price stays a bit.
Yeah, the price is more defensive in that area, but there's kind of a pockets of opportunity we can look at.
You're nodding. Is there something to add to that? That's fine.
Oh, absolutely. Yeah. The Canadian refining market is known to been at that much higher quality than the US. You see a little more tighter kind of ownership of a lot of the assets here. And so you've seen structurally higher margins in the sector and returns on capital than elsewhere in the US.
Right. Fascinating. So what do we do with the CapEx story from here? Again, you've mentioned, money is coming back to shareholders. There's at one point there was a lot of it and it was going back into the company, and now it's not. There does seem to be this question. We're in some version of a transition. Nobody really knows how long and to what extent we're all going to be using our traditional forms of energy, but there's going to be a shift at some point. What does that mean for CapEx? Like, will large companies need to be building the next generation of improvements into their companies, or is it actually going to hold because we're going to use basically less carbon?
Yeah, at some point, the key story around oil long term is, look, there's only a finite amount of tier one, i.e. like really economic resource out there. So as you start going into that second phase of resource at some point, potentially close to the end of this decade, that's when CapEx budgets have to start creeping up a little and you have to start rebuilding capacity. This has been a structurally underinvested space for a period, and eventually you have to start rectifying that. And whether that's in the near term or long term, it's not entirely clear when that happens. But so far, what you're seeing today is everyone's doing more with less. They're drilling a lot of really good and cheap resource today, and that probably doesn't change, really in the next couple of years.
And so those are the fundamentals you go with for now, because that's looking pretty good. And anything to add on that? So the CapEx side?
CapEx for midstream probably is more important because as the demand grows, they probably need to build more pipelines to support that. Yeah, so we don't see.
How do they build more pipelines? It does not sound like an easy job.
Yeah, so so far there's no a huge mega project we're gonna build in the near term. More about tuck-ins, and then there's some a small just wrapping up certain a project we already started, like LNG Canada or Coastal GasLink. So that's kind of in the wrapping up phase. But going forward, there's a smaller mid-size or smaller size project could be built. But then a lot of companies, they are very cautious about shareholder return, the leverage, how to balance that. So the company kind of show their kind of a calculus, how we can balance growth versus maintain kind of a dividends, a return to shareholders, and balance our leverage. So people are very aware of that.
That's fascinating. So that keeps, as you say, the companies being sort of a higher quality and less speculative, but it also keeps a bit of a cap on the price, right? If there's this commitment not to overdo it, does that translate to the price, or is that just a function of OPEC and the global story? I don't know.
Yeah, no, if anything, it keeps a floor on the price. It keeps a
floor on the price.
Yeah, okay. So if producers aren't given the ability to grow into higher prices, despite it being significantly above the marginal cost production, it means that release valve that you would normally see that corrects oil prices back to that economic cost is kind of broken for the time being. And I think you've seen that, the correlation between CapEx and kind of oil prices kind of broken in the last couple of years. The challenge is if we stay at higher levels for longer, at what point do shareholders say, you know what, you're allowed to start spending a little bit more into this? Because at some point the returns start getting a little nonsensical. So there will be a moment where we might see a bit of a pivot, but for now, I think the focus is returning cash to shareholders as fast as possible.
It's really interesting. Okay, fascinating how all of this kind of fits together in all of it. When we see discussions about, I guess this just goes to the resilience of the companies through different types of market environments. It's the commodity story. It's probably the cyclical story. Again, basically, are the companies in a better situation to manage different types of market landscapes and environments, and recession proof? Are they better recession proof today than they were, I don't know, a few years ago? I'll go to you first.
Yeah, definitely, especially for like kind of an oil field services name was like notorious before for like their higher balance sheets, like in peak and trough cycles. But right now they're in a much better place, like as a starting point in terms of the balance sheet. And also like you have seen, given the stable, relatively stable favorable commodity price, they have been buying back shares like aggressively, like certain names in my coverage that like buy back like a 40% of share outstanding. So that's kind of an offsetting to that because per share, like you earn more going forward. So that's kind of as also set the floor on the price as well.
So less speculative, giving more money back. That sounds like something you can retire on. It's different. That's different.
I would
right?
certainly say so. And look, I would have been a tough person to convince previously, just given my preconceived notions of the space. But in spending that much more time understanding these businesses, talking to management, you do realize that they've kind of recession-proofed their business as much as possible. And these are just different securities than they have been historically.
So they
I would say
potentially belong in different places when you're allocating.
And I think over time you will see folks like myself who've spent time studying high quality businesses start to pay attention, because where else can you sort of see 10% plus type capital returning businesses in the market today? It's kind of few and far between at this point.
Fantastic. Okay, more questions coming in. These are great. So we touched on this. Let's go back to it. How can energy businesses use AI within their business models? I mean, this is of interest to everyone. So you mentioned a little bit, but just swing back around to how you see this coming through ultimately to valuations.
Yeah, it's more on the productivity piece than anything else. You should see them doing more with less, which basically means more capital returns to shareholders fairly quickly.
Yeah. And Lulu, just your comments. Something similar, actually.
Yeah, it's similar. It's actually a certain company in the oil field services name, they have a lot of data. So they can do a lot of analysis on that, and then maybe not directly related to AI yet, but that's the direction of travel they can do.
A lot of the discussion around AI and energy today is mostly relating to power demand. Obviously, there's a lot of energy requirements to run a lot of these computers and servers at this point. But look, it's a long dated question. I think the near term question around gas more than anything else is the LNG demand pull. So certainly, I think the long term outlook related to AI is positive for energy demand. Okay. But in the interim, I think there's more pressing questions around storage and how we enter 25 and see the LNG pull.
Okay, fascinating. How far out would you put that? Sort of 3-4 years before it's got a real sort of running on the ground?
Probably have to ask Sam Altman on that one.
Okay. Here's a question about gas prices in BC. So gas prices in BC are higher than other places in the country. How can gas prices be lowered? What needs to change? So you've talked about sort of the buildup, but actually this is going to the price story, which, I mean, actually gas prices have had problems getting up off the floor, but what's the BC story?
A lot of it's infrastructure constraints. Again, the fundamental basis is everyone looks at the particular benchmark and then kind of prices up or down relative to that. And it's all based on infrastructure. At this point, if prices in a particular market are that much higher, it's solely a function of infrastructure constraints at that time.
Okay, so saved favorite question for the end. Why not? The dollar. So oil is priced globally in dollars. What do you do with a high dollar? What does it mean? What does it add to the overall story? Lulu, we'll ask you first. We got a high US dollar. It doesn't look like it's going anywhere soon.
Yeah, because of some of my pipeline companies, they earn USD. So higher dollar, that's translating to better like a Canadian profits. So that's a favorable like tailwind for some of my names. Yeah.
Okay.
Yeah, it's a simple story. Look, revenue is being priced in US dollars and your costs are in Canadian.
Yeah.
What does that mean for free cash flow over time? It's positive.
Fantastic story for it all. Lulu and Jen, thank you for rounding out the week with one of the most fascinating stories in markets today. Delighted to have you both here.
Thank you.
Have a good weekend.
Yes.